Hello, welcome to the week ahead in charts. It is week 35, 29th of August. My name is James Kim, one of the sales traders here in Australia, recording live here in Asia Pacific. These are the instruments we'll be looking at today. We'll look at the technicals over the US dollar index, followed by the euro, the cable. We'll look at the Aussie dollar and the dollar yen. In terms of indices, we'll be looking at Nikkei Futures. We'll also look at the Hang Seng index CFDs, followed by the S&P and the Aussie 200 index CFD as well. We're also going to be looking at WTI crude futures. In terms of commodities, will be followed by copper, gold, and this week we're going to be looking at the US 10 years, 5 years and the 2-year bonds. Now last week we mentioned that it really was make or break for the US dollar, and after a number of threats it made to trade below the lower trend line of this channel, which is defined by the green trend lines, the US dollar had the catalyst it needed to really finally lift off from here following Friday's Jackson Hole event. Now the resistance level for this week is obvious. The US dollar looks to be on track to test its 200 DMA, and a settlement above here for the week will be the ultimate test and will also be desired for those US dollar bulls. But till then, the first hurdle is at the 50% retracement, which I'm just putting up here now, between the July highs through to last week's low. That's at 95.84, and the 61.8% retracement level just below the 200 DMA is 96.26. So these are the levels where the US dollar index buying may potentially stall. A big outside day for the euro on Friday with a clear fail at the lower trend line of this channel, and the path is set for the euro this week to potentially test its version of the 200 DMA. The euro had one attempt, as you can see here, to settle back into the channel last week, which was met with no success. So on any reversals over the euro this week or moving forward, so any strength that we may see, we'll continue to mark this lower trend line as resistance zones, and for this week that happens to be at 113.40 up to 113.70. And those are the solid resistance level over the euro. Interim support for the euro above the 200 DMA this week would be, as I'm marking here on the Fibonacci retracement, 50% retracement, 111.38, just above the 200 DMA could be a level where the euro has a temporary breather. The consolidation over the cable is taking slightly longer than expected. However, for now we have clear trend lines to mark over the cable that will act as support and as resistance. The high of the week over cable came in at the upper orange trend line, which connects to June swing highs through to July swing highs here. So we will continue to work with this trend line as resistance unless we see a clear break above here. The outside day over the cable and its settlement at its lows illustrates momentum is skewed lower, so we expect the cable to at least trade down to the 130 handle over this week. We have now seen 3 consecutive weeks of bearish weekly price actions over the Aussie as it continues to struggle to claim a victory settlement above this blue trend line, which we have marked for several weeks now. As we mentioned in our previous calls, potential stronger gains over the Aussie is clearly being held down by copper. Focusing on where the Aussie will be first supported over the week, the first level we highlight is the 75 handle, this level around here, which coincides with a retest of this red down trend line which connected the 2014 highs through to this year's highs here, and which obviously the Aussie was able to break through 4 weeks ago. We only see a temporary hold here at 75 though, as if we observe that the Aussie's weekly swing highs in the past several weeks comes in below the 2016 high. So the Aussie may be on track for a bit more downside. Below 75, we will have a keen interest as the Aussie trades close to the lower trend line of this channel it is currently trading within. We also highlight that a retest of this orange trend line sometime this week happens to be where the Aussie has experienced some traffic here in the past, as marked by these red circles. A very strong price action and turnaround for the dollar yen as it closed in the green for the week after 4 straight weeks of losses. The dollar yen closed comfortably above its 50% retracement level between the 2011 lows to the 2015 highs, setting it up for further gains this week. A continued rally could see it temporarily hold at the higher channel trend line here, and this week that happens to come in just below the 104 handle. A retracement lower should see the 101 handle hold for the week. And the weakening yen gave the Nikkei the boost it needed to trade off its weakest point for the week on Friday. Now, provided the dollar yen continues to strengthen, this sets up the scenario for the Nikkei to enjoy a broad rally, with its first set of resistance to come in just below the 17,000 handle. So these levels here that I'm marking, here on the chart, and these are the levels that has capped Nikkei's rise on 2 occasions, once in July, once in August. Now, these levels are key for the Nikkei to take out, and I want to point out that resistance to be experienced here could be quite heavy, given that the 200 DMA is slowly creeping down to coincide with these areas of traffic. Upon a retracement south, we mark the 16,500 level as first support, which is this area that I'm marking here on the chart. Now, we covered the inverse head and shoulder formation over the Hang Seng last week, and as soon as this week the momentum could be there for this level to be taken out, which puts the Hang Seng on track to test the 61.8% inverse head and shoulder extension at 23,650. The S&P 500 last week failed to push to new highs last week, and the weekly close gives us signals that markets may be prepared to retrace lower. Friday's outside bar is also a big giveaway, so we will be looking at selling any rallies this week. This is an hourly chart over the S&P to highlight some levels. First level of interest to initiate a sell is the halfway retrace mark between the all-time highs here down to Friday's lows, and this level is set at 2176.5. Above here, we'll look for the market to fail at the 76.4% retracement level at 2185, given the struggles that the S&P has had at these levels all throughout August. Any shorts taking out this week would have stop losses above 2200. And you can also see the exhaustion over the ASX 200 as it closed lower into the week last week. So the Aussie index has its first lower swing high, and given the signals we have seen over the S&P, we obviously expect our Aussie stocks to follow their direction. We expect any rallies this week to be capped at this swing high here at 55.70. First support to come in pretty much where it is right now, 54.50, which is where the ASX is currently kissing this red trend line, which it broke above in July. A breach of this level, then we look at these double tops in May and June to hold temporarily for the ASX. Now, crude was able to halt its selling in the past week just below the 23.6% retracement level between the August lows to the high seen over just over a week ago. Notice there were no settlements below the 23.6% retracement level, so the market may be wondering whether crude is cautiously forming a base here before seeking fresh catalysts to make a added move lower. Resistance for the week is marked at 49.11. The August highs. Support is expected at 46.77. And below here, we could see selling temporarily halted at 45.32. It's 38.2% retracement level. Now, we've been covering our bearish outlook over copper for several weeks now, and this monthly chart, which we've also shared on a number of occasions, shows that copper is flirting at a key level. One can argue for a case for going long copper at these current levels, as it hovers just above the long-term green uptrend line, which starts in 2002. However, as we observe the continued decline in momentum being experienced over copper, it is difficult to identify a bullish case. Over to the daily chart on copper, the levels of support in the interim is upon a test of this purple trend line, which connects to January's lows to June lows. So that level for this week is 205.5 or 205.50. Crack below this purple trend line should see copper find support at these June lows here at 201.11. But given the failure over copper at the July swing highs, which couldn't even get close to testing March and the April highs, and the subsequent sell-off seen since, sends the signal that something big is brewing under the surface if it cannot get a change in momentum anytime soon. Any rallies this week over copper should see resistance over the 200 DMA. We have a specific trade set up over copper that's posted on Trading Floor. Please search for Edmund Liu's most recent sell trade idea over copper. On gold, we carry on the negative bias from last week after we broke below the attempted pennant formation. Gold experienced a decisive rejection upon its attempt here to trade back into that above the lower trend line, which was then met with continuous selling until on Friday, where gold experienced quite a decent rally, only to see those gains dissipate to close at its lows for the week. We marked temporary support level at 1310, these swing lows here, and below here we will have a strong interest over gold as it retests the 200 weekly moving average at 1291. A quick look at some US bonds before we end the weekly presentation. This is the weekly chart over the US 10-year bond, and you can see the support that the 10-year started to build throughout July and this month here, which was broken last week. Now, if we examine the previous falls in the bond prices for the 10 years, we are going to apply the September highs down to the rate hike in December last year. You can notice that the base has been forming at the 50% price extension level here, which it subsequently broke on Friday, and at the moment it is currently just trading at this trend line which connects December lows through to this year's lows. And an erosion of this trend line, we are targeting these levels here, 129.16, and this level happens to coincide with this price range extension applied to this year's highs. It's the same story with the 5 years. If we apply the same range, the September highs down to the rate hike we saw in December, if we isolate the Fibonacci extension to just display the 50% extension, you can see the strong support that it has received here, which it broke on Friday. So aiming for a 100% repeat in this downside range, we're looking at 119.5. Lastly, I just want to quickly show that the 2 years is exactly the same. initial support at the 50% extension, and I'm measuring the range between the September highs down to the rate hike in December. And if we isolate the extension to show the 50% extension only, you can see the amount of support that is received. So applying the same sort of logic, heading into a potential rate hike anytime soon, over the 2 years we're looking at 108.21 and a half. That is it in this week's chart presentations. Wishing everyone a fruitful and a profitable trading week ahead.